So in this session we will be learning about a proprietary ratio. So what is a proprietary ratio? Okay, so proprietary ratio is a kind of coverage ratio wherein we can understand how much your proprietary funds will be able to cover your total assets. Okay, so let's understand what is a proprietary ratio. Proprietary ratio is equal to proprietary fund divided by total assets. Okay, so now what is a proprietary fund? Your proprietary fund includes your equity share capital, plus your preference share capital plus reserves and surplus minus fictitious assets. Okay, so what is a fictitious asset? Fictitious assets include profit and loss account debit balance, that is accumulated losses, then miscellaneous expenditure which is appearing on your asset side of balance sheet to the extent it is not written off. Okay, so all this is included in your proprietary fund. Now total assets include your fixed assets plus investments plus net current asset. Net current assets means current assets minus current liabilities. Now in this case, if you see, your fictitious assets are not included in your total assets. Okay, now we'll see one example on how to calculate a proprietary ratio. So this is the example. In the books of XYZ Company Limited, balance sheet as on 31st March 2017. You have particulars, then current year amount. Then in that you have sources of funds, owner's fund. So owner's fund, you have 40,000 equity shares at rupees 10 each, 4 lakh. 10,000 8% preference shares at rupees 10 each, 1 lakh. Reserves and surplus 3 lakh. So total owner's fund is 8 lakh. Then you have borrowed fund, 10% secured from ABC Bank, 1 lakh. 10% secured debentures, 1 lakh. Unsecured loans, 1 lakh. So total comes to 3 lakh. So total sources of funds is 11 lakh. Then you have application of fund. In that you have fixed assets minus gross block is 6 lakh minus accumulated depreciation 2,50,000. So net block is 3,50,000. Then you have investments 3 lakhs. Then you have current assets, loans and advances. In that inventories 1 lakh, sundry debtors 1,50,000, cash and bank balances 1,50,000, loans and advances 1,75,000. So total current assets is 5,25,000 minus current liabilities and provisions. You have sundry creditors 2 lakh, provisions 25,000. So net current assets comes to 3 lakh. Okay, then profit and loss account debit balance 1 lakh, miscellaneous expenditure to the extent not written off is 50,000. Okay, so now if you see here, we'll calculate the proprietary fund ratio, okay, or proprietary ratio. So proprietary ratio is equal to proprietary fund divided by total assets. So proprietary ratio is equal to proprietary fund divided by your total assets. Okay, so what is a proprietary fund here? Proprietary fund is equity share capital plus preference share capital plus reserves and surplus minus your fictitious assets. So how much is the equity share capital? 4 lakh plus 1 lakh plus 3 lakh. Okay, so it comes to 4 lakh, that is equity share capital, plus 1 lakh is preference share, plus 3 lakh is reserves and surplus, minus fictitious assets. So how much is the fictitious assets here? Profit and loss account debit balance is 1 lakh and miscellaneous expenditure is 50,000. So minus 1 lakh minus 50,000 divided by total assets. So let's see how much is the total assets. Total assets is fixed assets plus investment plus net current assets. So fixed asset net block is 3,50,000, investments is 3 lakh, net current assets is again 3 lakh. So 3,50,000 plus 3,50,000 is fixed assets plus 3 lakh plus 3 lakh. So let's see how much does it come to. So this comes to 6,50,000 divided by 9,50,000. Okay, so it comes to 0.684. Okay, so your proprietary fund is 0.684 times of your total asset. So your proprietary fund is able to cover your total asset to the extent of 68.4%. So what does that means? The balance total assets are covered by your loan fund or borrowed funds. Okay, balance total assets are covered by your borrowed funds. Okay, so this is how you calculate your proprietary ratio. Thank you.